All right, and if you will turn to sequential, I say sequential page, those are the ones marked in pencil. If you turn to sequential page 6, is Freddie Mac. Now, Freddie Mac is the Federal Home Loan Mortgage Corporation, as you all know, was formed around 1970, actually in the late 60s, and is a member of the Federal Home Loan Bank Board, which governs all federally chartered savings and loan institutions. And they basically lend money out, okay, that meets their underwriting guidelines. It's like linear programming. They have certain parameters that they will lend money out on. Presently, and it's the first change you're going to have to make in the book, you will notice that conforming money obviously is 98.5. You'll see in your book it says 93.750. They changed that about 3 days after it went to the printers. There will be numerous small changes to make as we go through the course, and there will be 3 errors, not major errors, but errors in the book that we'll go over. Now, they have to go out in the scheme of things. We're talking about the flow of money. They have to go out and borrow money themselves. They raise money primarily 3 ways. They have mortgage-backed securities, okay, you won't see it in the book, but private placements, and what are called participation certificates. Now, the next one, okay, is Fannie Mae. Now, Fannie Mae, you'll even be more familiar with. Now, Fannie Mae is the Federal National Mortgage Association. All right, you will notice in your book it'll say associate. Obviously, that means association. And it was formed in the 1930s. Now, Fannie Mae, for those of you that have been around a long time, is really the oldest secondary marketing institution that we have, as in it was formed in the 30s. And as a matter of fact, when it was formed, it only bought FHAs. That's really one of the reasons that it was formed. After World War II, I don't think anybody here will remember World War II.
I'm a senior citizen.
All right. After World War II, as you know, they got very heavily into VAs, and then later in the 60s they got into conventionals. And although Freddie Mac and Fannie Mae can both buy FHA and VAs, primarily they stick with conventional loans today. One reason that the VA quotes that you would get from Freddie Mac, for example, are very high because they're pegging the points to what their conventional rates are. And as you know, with rates being, let's say, 15 3/4 today, pegging it to 14.5, okay, it would be a very heavy discount if they peg it on a true basis. So they don't really do as much VA or FHA, okay, as they used to. Now, Fannie Mae is kind of a quasi-governmental organization, as you know. They have people both from private industry and the government that sit on their board, okay, and they're audited by the federal government. Now, they raise money 3 ways, too, okay? They issue short-term notes. They issue mortgage-backed bonds. Those are discount notes, okay? And they issue debentures. As I say, they all have to go out, you know, they have to raise money too in the marketplace. Now, there's a little note at the bottom of your book there, and the note will tell you that Freddie Mac and Fannie Mae tell you that it's not in their best interest to lead the marketplace, because they have to go out and borrow money, don't they? And if they have to go out and borrow money in the marketplace, and the insurance companies are looking for their best rate of return, they have to pay a premium for that money. And so in turn, if they have to lend it back out again, it's going to cost, you know, us, those people, those of us that are looking for loans, it's going to cost us a premium. That's why, does anybody here get the peak report? Okay. It's a very interesting thing that took place about 3 or 4 weeks ago when I was reading it. Basically, the peak report has the mortgage loans all over the city, okay, for all the savings and loans and mortgage banks. And it gives all the rates. And a couple weeks ago, they were like, everybody, like almost identically, was at 15 1/4. Some of them were 15 1/2. Only one person, I think it was BF Saul, was at 14 3/4, and usually they come in and they'll come out in the marketplace. When you see something like that, where all the rates are the same, it really means that we're in a period of disequilibrium, aren't we? Because there's no money in the marketplace. The only place everybody has to turn to is Freddie Mac and Fannie Mae, which they can only get money at a set rate, okay, through the auctions. So all of a sudden, if you see everybody out there at the same time, now, a savings and loan, for example, they could put money out at 13%, couldn't they, if they wanted to, as long as they're willing to hold the note. They can't get rid of it once they take it in, right? They can't sell it. They could sell it, but by the time you have a yield difference and they sell it off to Freddie Mac, there's going to be nothing left of a note at 13%. so they're forced to hold it. But even the savings and loans aren't out there with money, are they? Lower than what the regular, what the rates are today, which are running, around 15 3/4, 15 and a half, 15 and 3/4. There is very little money in the marketplace now. We're going through truly a revolutionary period. I don't think there's any doubt about that right now. There is just no money. Insurance companies are a good example. They used to have tons of money. Now all of a sudden, one or two things are happening, okay? People are not making their payments. Okay, they're just defaulting on their policies. Why should you put your money in a policy that's going to give you a 2% return when you put it in a money market fund at 15 or 16%? Okay, so they're actually literally defaulting on their payments today. And then, of course, the second thing is that they're borrowing on their policies, aren't they? So life insurance companies really have very little money to lend out. And that was a big source of money for the marketplace. Now all of a sudden people are starting to turn to pension funds, but pension funds for years, they've had very tight regulations on what they can put in the market. So everything's getting very tense right now. So there's no money in the marketplace. When you see that, you see rates all pegged to the same type of index. All right, it means we're running into a problem. Anyway, the third one that I want to talk about today, and one that has become increasingly popular, okay, in the last couple of years, and much abused too, as we all know, is Ginnie Mae, the Government National Mortgage Association. Now, it's formed in the last 2 years, and the key to Ginnie Mae, to the incredible success that they really have, are two things. One is the fact of the guarantee, that the government's going to step in back, and it will stand in back of it. And then the second one is the fact of the pass-through provision. Now, Mary makes her payment. She has a VA loan. Mary makes her payment to me at my mortgage company. All right? Now, we happen to service loans. Okay? First Mortgage, we service our loans. Which, by the way, when times get difficult, okay, and there's no loans and very little money around, those companies that are fairly well endowed can fall back on their servicing income. Does everybody understand what servicing is? Okay. She has a VA loan. Someone out there, let's say the XYZ company in Massachusetts, is holding the actual VA certificate, okay, in which they're getting a certain amount of interest in the payments. However, they don't want to send Mary her payment every month, and then Terry, okay, then Bob. They want to send, so they have somebody service it. They have a mortgage company service it. To service Ginnie Mae's, though, you have to have a fairly good net worth, okay, for the reason I'm going to explain in a minute. So Mary makes her payment to me. I'm servicing it. I service it in the sense that I get a certain income for doing that, okay, because I'm taking care of all the paperwork and everything, and they pay what are called 44 basis points for the privilege of doing that, and it's a good money maker. But all of a sudden something happens. One month Mary goes off to Hawaii, and she doesn't make her payment. You go to Hawaii quite a bit.
Scott.
All right.
Every week.
That's okay. So she misses her payment. Now I, the mortgage company, must pass through her payment to the certificate holder. That is called the pass-through provision. So whoever's holding that certificate knows they're going to get their payment every month, don't they? It's good as gold, really. It's like all of a sudden now Mary misses 8 payments. She says, "The heck with real estate. I'm going to Hawaii. I met some really nice guy over there." Okay. So she goes over, meets her bartender over there, misses 8 payments, says, "I don't care what happens in my house." And now all of a sudden, because she's missed so many payments, I get tapped out, and now I can't make the payment to the certificate holder. Now the government steps in and say, "We'll guarantee the deal." So we have the pass-through provision, and we have the guarantee. And in essence, it makes it just like having a treasury, doesn't it? Okay? That's why the yields on it are fairly good. And another reason why everybody wants to have it. So Ginnie Mae, as we say, has enjoyed just phenomenal success. All right. Any questions at all as we go along? All right. One thing, by the way, I want to tell you, you can go back in your book, but you can't go forward. The reason is I have certain answers and things as we go through, okay, if you flip forward. But you can always go back in your book. All right. What about conforming versus non-conforming loans? Now this you all know. This is a piece of cake. If you turn to sequential page 8, the only thing you'll have to change is in paragraph 1, the loan amounts. As you know, there's no distinction between 90s and 95s anymore. It's all 98.5, isn't it? Now, conforming loans are simply loans that meet the underwriting guidelines of the secondary market. A conventional loan that's conforming is presently 98.5. But as time goes on, these limits get raised, don't they? Those of you that have been around a long time can probably remember when conforming was, who knows? What's the lowest you can remember conforming, buddy? Oh, well, I should do that. That's not
can't
fair.
remember.
I'm sure it was probably very close to 98.5. Anyway,
Okay.
they buy loans that meet their underwriting guidelines, okay? And Freddie Mac and Fannie Mae do it. Anybody can buy a conforming loan too. There can be pools put together. Now, with VA and FHA, as you know, when we get into conforming, we're talking VAs, what, $110,000, no money down, and up to $135,000 with 75% exposure. And we'll get into some examples of that later on. When we get into non-conforming, that's simply the antithesis of what we're talking about, isn't it? If you had a conventional loan of $100,000 loan amount, that's non-conforming. It does not conform to the marketplace. Now, when we talk about where loans end up, if you turn to your next page, you'll notice at the top you have to change those loan amounts too. Now, conventional conforming loans can be held by a number of institutions. Okay? Savings and loans can hold them in their portfolios. Now, as you know, very few of the loans will end up at Fannie Mae. If they're going to get rid of loans, they're going to go to Freddie Mac because they govern the federally chartered savings and loans. And Freddie Mac and Fannie Mae, as you know, they can buy and do buy loans that meet their underwriting guidelines, which conform. That's what conforming means. And, of course, investors through mortgage brokers and mortgage bankers can buy conforming loans too. Now, when we get into non-conforming loans, all right, we're into a different ballgame, aren't we? Which is one of the problems that we have, especially you all out in the Vienna office dealing with a high price spread. There is not a lot of non-conforming loans. Okay, we're on sequential page 10 right now. You'll notice federally chartered savings and loans, okay, they can hold non-conforming loans in their portfolio, but they have very strict limits placed on them by the federal government. State chartered savings and loans, now that's a different breed altogether, and they can hold more non-conforming loans in their portfolios. But it depends on the state, doesn't it? Some state legislatures are easier to deal with. They're going to have easier loan limits for their particular state. So it depends on what state. And then, in addition to that, certain investors, such as pension funds or life insurance companies, okay, they can hold non-conforming loans in their portfolios, can't they? All right. Now, when we get into VA, we're into a different ballgame. A non-conforming loan, let's say, would be a loan of $150,000, wouldn't it, Grace? No money down. All right. What happens, okay, what happens, though, when you have a V? Now, as we know, you don't see too much in the sheets now for non-conforming VAs, but a year and a half, 2 years ago, there was tons of this stuff floating around. And if the regular market was like 4-1, on a non-conforming loan, it would be like 8-1, wouldn't it? And why would it be 8-1? Because the person who is going to hold that non-conforming loan, they've lost liquidity, haven't they? They can't get rid of it in the secondary marketplace. So, using the old greed principle, what makes up for a loss in liquidity, Grace?
Money up front.
Money, okay? Money pure and simple, okay? So what they do is they get more points, that increases the yield, right, of the note, and now all of a sudden they're happy to have it, okay? Knowing that they can't get rid of it. So that's why, for example, when we get down to a practical in the real world today, savings and loans, every once in a while someone will call me and say, well, you know, I got this guy through with a savings and loan and his ratios were 0.40 and 0.50 and now how did this guy get through? The reason was the savings and loan, they can take any loan they want, can't they? Within certain restrictions. But since they cannot get rid of that loan because of the high debt ratio, let's say, into the secondary market, they have lost something, haven't they? What have they lost, Terry?
The ability to liquidate.
That's right. They've lost liquidity, haven't they?
What about participating? Is it not possible to get a participation on the 135 of that pot?
Yeah, but when we're talking about the real world and out in the general market now, I'm not talking just about savings and loans. I'm talking about anybody who's willing to hold a non-conforming loan or something that doesn't conform, whether it's to debt guidelines or to income guidelines or to money or loan amount guidelines. The basic premise on which you go to is the fact that you're losing liquidity. And the trade-off for liquidity is an increase in yield, which makes everybody happy. But when there's no money around, people get nervous, don't they, like today? And when people get nervous, they're not so willing to hold that stuff in their portfolios, no matter how many points you want to give them. Right? And that's one of the problems today, why you all don't see a lot of 200,000 no money down VAs, because people are very nervous. Okay, that's not the entire reason. Okay, people are putting their stuff into liquid assets, okay, into money market funds that can be liquidated fairly quickly. Liquidity means a lot in this business. That's why you're going to see the end of the 30-year term mortgage. Okay, there's no doubt about it. I don't think there's any doubt in anybody's mind today. It's just a question of time. If you're an insurance company, Mary, and you're collecting hundreds of millions of dollars, and you want to get the best rate of return for your company, I mean, are you really seriously today, are you going to dump it in a 30-year fixed term? Okay, even at 15.5%, because the rates may go. Well, Henry Kaufman says maybe the prime's going to bounce up to 25%. Okay, he self-fulfills his own prophecies, doesn't he? Okay, all of a sudden people get nervous. There's a lot of people out there, Mary, if you were a portfolio manager that put $100 million in loans at 12% because you thought there was no way it's going up to 13, okay, Mary would now be selling real estate, okay? All right, that's what's happened to those people. So they get very gun-shy, don't they? And they don't put their money into the secondary market or into vehicles where we can get 30-year fixed terms, even if it's non-conforming. I have on my desk now, it's unbelievable, just in the last 2 days, I have requests for somewhere close to $50 million in money that builders want. But they all want non-conforming, stuff they can buy down to 12 and 7/8, and, but there's just very little of that money around. And so unless that builder has a construction loan with the company that's willing to handle him on the permanence, okay, and if he does that, gives them the non-conforming buy down to 12 and 7/8, they're not going to be able to get rid of it in the secondary market, are they? So they're going to lose liquidity. But still, they're kind of caught in a bind, aren't they? They got the guy in a construction loan. They don't want the guy to take the tube either. Okay, so it's kind of a trade-off. All right. Any questions at all? Now, we said state chartered savings and loans can hold non-conforming. Also, mortgage bankers, okay, they don't hold the notes themselves, do they? But they can service it for individual investors, such as life insurance company, pension funds, etc. When we get into VA and FHA, VA conforming loans we've already talked about, they can go into Ginnie Mae's quite easily. We have no problem with that. There is no such thing as a non-conforming FHA. As you know, presently, the FHA limits are 89.5, and then for condos, they're 74.9, aren't they? Okay, you should know the distinction. We're going to talk about that a little bit later on. All right. Now, let's start talking about some of the formulas that we're going to talk about. And the first one I want to talk about is the conventional formula. If you turn your page to sequential page 12, this is one that you should all be familiar with. All right? Now, basically, the conventional formula is a two-part formula, isn't it? The first part of the formula is PITI plus MIP, if the loan's going to be insured, divided by gross monthly income, because all underwriting is done in terms of months, isn't it? Whenever we talk about underwriting, everything is in terms of months. So if you have a yearly figure today, which you will later on, you're going to have to reduce it to a monthly figure. Anyway, divide by gross monthly income, and it should not be more than 0.28. The second part of the formula is PITI plus MIP plus debts. Extend your line over. The printer missed it. I have it here. You can see the debt line going over. Divided by gross monthly income should not be more than 0.36. Now, a couple things. One is I'm going to ask you to memorize about 7 or 8 things as we go through this course. You will see later on when we get into application areas. The first thing I want you to remember is down in number 2, the difference between Freddie Mac and Fannie Mae on how they count debts. Okay? You'll see Freddie Mac, any debt over 7 months counts as a long term, and Fannie Mae, anything over 10 months. So I want you to memorize that as we go along. Now, a couple little hints. One, those of you that write a lot of 5% down notes. Now, by the way, underwriting is not etched in concrete. All right? It really is subjective. There are formulas, although a lot of underwriters will deny that they use formulas. You call up FHA and say, by the way, what's your formula for it? They'll hang up on you. All right? Now, the reason they do it is basically for discrimination purposes. They don't want one person approved at one set of numbers and then the other person disapproved at the same set of numbers, okay? At least a lot of lawsuits, doesn't it, things like that. So they deny that they use formulas. And in truth, even though they really use formulas, okay, what they're really saying is that it's only one aspect of underwriting. As we know, in fact, when we talk today, and I'll ask Terry, I say, now, does this person qualify? We're talking about qualifying in a technical sense. We're talking in terms of numbers. Because there's other things that go into underwriting, aren't there? Okay? There's things like credit reports, okay, length of employment, how much cash was put down, how much money's in the bank, what kind of savings pattern somebody has. So there's other things that go into underwriting. Now, that being said, when you get into, for example, your 5% down loans, you have to be a little careful. You should try and stay to the old formulas last year, okay, the 0.25 and 0.33. All right, those of you that do write 5% loans. Once you start to get over the old limits, the 0.25, and start bouncing up towards 2.8 or bouncing up towards 3.6, you're asking for trouble. All right, and when you start doing that and getting over these limits, all of a sudden they're going to start looking at things like how much cash they have in the bank, how much really went down, savings patterns, things like that. So it can be very touchy when you write a 5% down loan. Another little trick in the business is, you know, if you have somebody that doesn't have any debts at all, you can generally go up to about 0.30 on both ends of the formula. All right? But once again, it has to be a clean case. It really does. Now, usually at this time I get a hand come bouncing through the air and say, well, you know, but I had this guy got through at 0.38, 0.40. I don't doubt that. In fact, it's true. But if you think about it, where the loan actually ended up, it probably ended up either in a holding company that maybe had a savings and loan that was part of it, or maybe directly with the savings and loans, because they can hold that loan themselves, can't they? They can hold it forever. They can give you whatever ratios that they want. Okay, any questions at all? All right, what are some of the advantages, by the way, of conventional loans? Nope, don't flip up that sheet. What are some of the advantages of conventional loans today?
What you just said, there's some flexibility that maybe you don't have. Or no.
Less paperwork and so.
Less paperwork, a lot quicker. Savings and loan, they can settle a conventional case for you in a week, really, if push comes to shove, can't they? Try doing that with FHA sometimes, see what happens to you. Okay, or VA, even doing a VA automatic, there's no way. It's not comparable. Okay, what's the biggest advantage of conventional loans today? Points. Points, absolutely. Today, okay? I mean, let's face it, savings and loan, you can get by with 1 point, maybe no points if they want to. Okay, with the VA and FHA, we know you can't do that. So in today's market, even though it's not as easy to qualify, the fact that you don't have a lot of points, okay, really are a good determinant when you're out there writing a deal today. Any other advantages that you can think of?
Anyone can get a loan and can qualify.
Right, absolutely. Looking here. Okay, absolutely true. Okay. Anybody, it's non-discriminatory in the sense that VA is, right? Okay, what else? Anything else? Okay, no hard guidelines in the sense that you could have a conventional loan of $1 million, couldn't you, if someone wanted to hold a note? Okay, with FHA you can't do that. What are some of the disadvantages of conventional loans? Mary?
Chaos.
Prepayment penalty? I want Mary to come up. She's just sitting there, sitting there thinking of Hawaii. Probably play Hawaii in her brain today. What's the biggest disadvantage of conventional loans today, really? As I say, let's say a VA guy, you're taking somebody out to show them a VA house versus someone conventional. And they both make the same amount of money.
Well, it's harder to qualify.
Much harder to qualify, isn't it? I mean, really, a lot harder, especially with the interest rates being what they are today. Okay, what else, Grace?
That's what I was going to say, higher
Yeah,
interest
that's
rate.
absolutely the best. What happens, how about something where you have a 5% down loan? What disadvantages are there? Or a 10%? What happens if you have a 5% down loan today? You have to, almost, huh?
You have a higher interest rate, lower rate.
Yeah, higher interest rate, lower ratios, and what else do you have to put up front for a 5% down?
Points.
No, not points, insurance premium. Okay, there's a difference. It's not considered a point. Okay, it's insurance premium. Yeah, in the sense the guy's putting the cash out, right? For a 5% loan, he's got to put how much money up front at closing? One. Okay, 1% up front, and then when the loan's going on, what does he have to pay? He pays some MIP, which is generally a quarter point, isn't it? All right? What happens when someone, for example, has a 90% loan? What do they have to do? Have to put a half point on it. Okay? Does everybody know that? Okay. Did you know that?
No.
No, okay. All right, you gotta be careful when you write that 5 or 10% down loan, because it does cost more. If we have a loan and the interest rate's 14%, okay, no, 13 and 7/8. All right, it's 5% down loan, and then there's a quarter point. Is that 14 and an eighth interest rate? Does that make it 14 and an eighth?
No, not for 30 years. That would just mean you put the half point up
Would you-
front of the beginning.
If I'm a
That's
prospect and I'm
13
talking to you and I say, Grace, wait a minute now. I said, don't try and rip me off. It's 13 and 7/8 here, plus a quarter point. It's 14 and an eighth, isn't it? Is it 14 and an eighth?
Over 30 years, no.
No, not over 30 years, okay? It wasn't quite what I was looking for. Basically, an insurance premium is just that. Most of your agents that have a lot of experience, they know when you have 13 and 7/8, or 14 and 7/8, or 12 and 7, you never add that quarter point on. It's 13 and 7/8 plus a quarter, not 13 and 7/8 and a quarter. And you know why? Because the most serious objection you can have in our business, okay, and I keep an active license even though I don't use it, but the most serious objection that you can have in our business is what we call subconscious objection. That's an objection that's deeply held, deep down in somebody's subconscious, and they're not telling you about it. And so that guy's kind of sitting there and saying, God, 14 and an 8. And all of a sudden, you just turn a master switch off in his brain. And there is no way that he's going to buy that house, no matter what you do. All right? But at 13 and 7/8, he's rationalized 13. It's like the old, say, why does Safeway always have $1.99 a pound? Okay? They don't think in terms of two, do they? $2 a pound. You're thinking of $1 in something, okay? There's a reason for that. The same way when you say 13 and 7/8, it is not 14%. A lot of your newer agents will take that quarter point, add it on, won't they? And they'll say, well, it's 14 and an eighth altogether. Okay, they're going to lose the deal. All right.
Excuse me, can you back up on that? Because that's exactly what I've been working on the premise when I've been doing FHA. I've been adding the 0.5%, so I've been now using 15% figure.
You shouldn't, because you turn that master switch. Well, I'm not buying that house from you now, Grace, because it's 15. And I'm going to look at you. You know what I'm going to tell you? I'm going to tell you one of two things. Hey, Grace, you're just a fantastic agent. I love the house. I'm going to go home and go think about it. I'm going to call you tomorrow. Honest to God, I will. Or well, I'm going to look at you and say, you know, Grace, we really love that house, but you know, my wife just doesn't like a house that's painted yellow. But what I've really told you is that at 15%, there is no way I'm going to buy this house. You turn this master switch off. But humans being what they are, am I going to come out and say in essence that I'm too cheap and I can't afford that house? I'm not going to say that to you, am I?
No.
Because I have a certain amount of respect. It's just like if you ask somebody, why have you ever missed any payments on your, on your credit report? Well, I missed 1 or 2. What's that guy telling you? All right? Maybe he's missed 8 or 9, but am I going to come out as a prospect and say, hey, Mary, 8 or 9, I really make lousy payments, I spend money, drink a lot. Am I going to, as a human being? No, I'm not going to come out. I'm going to say, well, I missed 1 or 2. It's the same way with that, too. Okay?
But isn't that what it is in effect? That it does come out to be 15%?
No, it's an insurance premium. Okay? You can add the dollars up. Taxes aren't the same as P&I, are they?
No.
Okay. Well, it's insurance premium's not the same as an interest
Are
rate.
you going to show us how to figure that out?
No, well, yeah, later on, there's a couple little tricks we'll do. But it isn't. It's a small distinction, but it's an important one, especially now that interest rates truly are outrageous. Okay? So we'll talk about it. All right. The next thing I want to talk about, by the way, any other disadvantages that you can think of? How about rarely fully assumable? Okay? So we really have 2 big things today, don't we? All right? We have higher interest rates, harder to close, okay? But the non-assumability feature today is a very, very serious problem. No doubt about it. We will talk about it. It'll come through the course all day long. And it's created a lot of problems, okay? I hope there's not a lot of you out there all of a sudden doing a lot of raps on conventional loan, all right? I'm not going to ask for a show of hands. All I'm saying is that you should be very careful, okay, in what you're doing. That's why seeing VAs and FHAs get a rap, but really not a lot of conventionals because of the due on sale clause. Okay, let's talk a little bit about FHA. But before I do, FHA, the people down there are very, very nice people. I've known them for years.